Over the last 24 months, prices have risen by 8.6%, meaning it now costs 1,086 to buy something that only cost you $1 2 years ago. And if we annualize this number, it comes out to 4.3% per year. That's an enormous amount of money being stolen from your wallet without you even realizing it. So what the hell is going on? Well, inflation is a fancy term that economists use to describe the erosion of our money's purchasing power over time. Because of inflation, our dollar today is worth less than it was yesterday. And since everything we buy is measured in dollars, we need more of them to buy the exact same thing. So in this video, I want to explain how inflation is stealing your money, who is being hit the hardest, and then finally what you can do about it. And right off the bat, I want to say that inflation is not a new phenomenon. In fact, since the Great Depression, inflation has averaged around 3% annually. But there's a couple important caveats to keep in mind. First, while the average inflation has been 3%, there were decades where inflation was negative, which means we actually had deflation. For example, during the Great Depression, the price of goods and services fell almost 7% in 1933 and another 4% in 1934. This led people to hold on to their money since it was becoming more valuable every single day, and therefore they weren't spending it. But the problem with not spending money is that businesses start to fail since they do not have any revenue coming in. And once those businesses fail, more people lose their jobs and the economy starts to spiral out of control. That's why policymakers try their best to keep inflation at around 2%, which is just enough inflation to ensure that people keep spending money, but not so much that our entire life savings are wiped out. Second, while we've experienced some bouts of high inflation in the past, like after the end of World War II, inflation over the last 40 years has been relatively low and stable, thanks to something called the Great Moderation. The Great Moderation refers to a period of low inflation and economic growth, starting in the early 1980s, following Paul Volcker's aggressive monetary policy tightening. Prior to the early 80s, inflation averaged around 6% annually, but it declined all the way down to just 2% by the turn of the century. This meant that your $100,000 salary would maintain its purchasing power much better than it could have in the decades before. But just like the name suggests, this moderation didn't last forever, and inflation has been picking up ever since. So how is inflation stealing your money? Let's say that you have $1,000 sitting in your bank account, earning 0 interest. Now 1 year from now, you plan on buying something that currently costs $1,000, like a TV, but because of inflation. Now this might not sound like a big deal, but let's extrapolate this out over the course of 20 years. If inflation averages even just 3% over the next 20 years, the price of this TV will rise to $1,300. That means your $1,000 savings will no longer be able to buy you a TV. Or if we assume that inflation rises at 4%, the TV will cost $2,000, meaning once again, your $1,000 won't be able to buy you the exact same thing. But the crazy part about this isn't that you're losing the ability to buy things that you want, but rather the things that you need. For example, right now a gallon of milk costs $4, and if we assume that inflation stays at 4%, a gallon of milk will cost $5.16 by the end of the decade. A loaf of bread currently costs $3.25, and by the end of the decade, it'll cost $4.81. Steak is currently $8.11 per pound, and by the end of the decade, it'll cost $13.17. The most alarming though is the fact that a dozen eggs will go from costing $3.64 to $6.90. And the reality is that these numbers are just lowball estimates, since inflation has averaged 4.3% over the last 2 years. It's entirely possible that these numbers will end up being far higher. So what's causing this inflation? Well, the main cause is excess spending. Over the last 2 years, the government spent trillions of dollars trying to stimulate the economy. And while this did prevent a depression, it also led to an excess amount of money flooding into the market. When this excess money enters the market, it drives up the prices of goods and services. And the more money that gets printed, the higher prices increase. But the problem with this is that wage growth has not been keeping up with inflation, which means that we need more money just to buy the same thing. In fact, according to data from the Bureau of Labor Statistics, the average worker needs to earn $24.90 per hour to keep up with inflation. But the reality is that the average worker only makes $22.75 per hour. And since workers aren't getting paid more, they're now turning to credit cards to cover the difference. According to CNBC, credit card balances have reached an all-time high of $91.1 billion. That's an increase of $46 billion, or 9.9% from the previous year. And until wages catch back up with inflation, this trend will continue to worsen. As a result, many people are finding themselves trapped by inflation. I recently read this Reddit post that really exemplified the pain that inflation is inflicting on regular Americans. This woman works as a waitress and takes care of her mother-in-law who has dementia. Her mother-in-law requires full-time care, and her husband helps out whenever he's not working his full-time job as a truck driver. She says that she can barely keep up with her bills as it is, but a few months ago, her car broke down and she was forced to take out a loan. And unfortunately, her story is not unique. Everyone is being affected by inflation, but the group that's being hit the hardest is lower income earners. According to the Bureau of Labor Statistics, the overall inflation rate for the US is 8.6%, but for lower income earners, the inflation rate is 12.6%. What this means is that if you make under $35,000 per year, inflation is basically cutting your spending power down to a third. Instead of your dollar losing 8.6 cents of its purchasing power, it's losing 12.6 cents. Meaning that inflation is basically cancelling out all of your wage increases. The worst part about all of this is that inflation is a hidden tax that punishes you for saving money. And here's what I mean. Let's say that instead of keeping your money in a bank account earning 0% interest, you decide to invest it in a CD earning 5%. On the surface, this seems like a great decision. After all, you're earning 5% compared to 0%, which is technically true. But what this doesn't take into consideration is inflation. Remember, the whole point of investing is to beat inflation. So if you invest your money at 5% and inflation is 4%, you might think that you're doing well. But the reality is that you're still losing 0.5% to inflation. And when we're talking about investing tens of thousands, if not hundreds of thousands of dollars, this adds up quick. For example, let's say that you invest $100,000 into a CD that earns 5%. You'll earn $5,000 of interest every single year. But because of inflation, this $5,000 will only be able to buy you $4,870 worth of goods and services. And that's why investing alone is not enough to keep up with inflation. You need to invest in assets that beat inflation, which historically has been the stock market. Data shows that since 1871, the S&P 500 has returned around 6.6% annually, which is enough to outpace inflation. That's why I'm such a big proponent of investing early and often, even if it's just into a simple index fund. Now, in terms of what you can do about inflation, other than investing, there's not much you can do other than tighten your budget and find ways to cut back. Inflation is a monetary phenomenon that can only be solved with monetary policy. That means that it's up to the Federal Reserve and Congress to either reduce spending or increase interest rates to bring inflation back down to 2%. So that's what's going on with inflation. I know that it sounds depressing, but I wanted to put this on your radar so that you can start thinking about how you can prepare for this. Just remember that every single person is being affected by inflation. But if you start planning ahead and making small changes to your budget, you can easily weather this storm. And if you want to learn more about financial literacy, check out this video over here.